Hey there, everybody. Thomas with Basecamp Trading. It is Monday, August 14th, and we're going to take a look at crude oil here and continue on with our Mistakes Traders Make series. And the mistake we want to talk about today is one I see happen a lot of times with new traders, and that is not knowing when a trade fails, that it can often change the opposite direction. And they get stuck with the same idea that, hey, I'm bullish this market, it's going to go higher, it's going to go higher, and they'll continue to buy as it sells off, that type of thing. So what I want to talk about, the reason I'm using crude oil for an example, is because we had a really good setup in the trading room today that worked out really well in the opposite direction for a short, and we also had long setups in crude. So we were looking at crude oil for a potential long due to a resistance break here. Okay, so we had the resistance break, and then we set up right here this bull flag where we broke the resistance, had strong bullish momentum, pulled back, put in the lower high, triggered by breaking the previous bar's high. And with this setup, you have the expectation that once it triggers, it should accelerate away. So once it's broken that previous bar's high, it should continue to accelerate. And it should never go back down below what we call the no-go zone, which is this area down here. And if it does, then we say, okay, that bull flag has failed. So that setup that was a good bullish setup failed. And when it fails, a lot of times a failed bullish pattern will turn bearish very, very quickly, especially a failed breakout flag like this. So when it fails, you'll know that because it breaks into the no-go zone, going back below the low of the retracement on the flag, which is 48.86. And as soon as it does that, you look for it to accelerate down. And you go, okay, first support right here, second support down here, and then we set up another bear flag and triggered and accelerated down even further. So the mistake that a lot of traders make is they'll go, okay, here's a bull flag, and they'll take the long, and it'll fail and start to pull back, and they go, oh, well, I'm still bullish, and this is an even better place to get in. And they miss the fact that if this market was going to go higher, it should have climbed when you had that bullish setup trigger, and they'll continue to buy as it sells off, and it'll just take off and end up compounding their loss and turn into a really big loss. So don't be afraid to change your opinion. Listen to what the charts are telling you, and also make sure you have expectations and a plan on how that trade should behave. All right, you should know what that ideal situation is how that ideal situation is going to play out once you get into a setup before you actually are placing the trade. So your plan, you should know, okay, if I'm trading a breakout flag like this, my expectation is that it's going to accelerate straight up from here, and if it doesn't, then I know it has failed, and I'm out of that, and I'll be looking for it to move the opposite direction. So again, have expectations. That's one of the things we work with people a lot of times when doing is establishing, okay, what type of expectations do we have for this particular trade setup or for this strategy that we're using? And we teach people how to put together those strategies. All right, so that's all I have for you for today. I hope it helps. I will see you in the trading room bright and early tomorrow morning. Don't forget to like and subscribe. We're trying to get up to 20,000 subscribers here, so help us get there. And until next time, happy trading.